So I got this chart up today because let me know how the audio is, by the way. New environment here. This is basically a chart showing from 1928 the seasonal weakness of the S&P 500 or the stock market in general, right? So we are entering seasonal weakness. Keep that in mind as we check if the technicals support a bounce here, right? Are the technicals going to support a market bounce? Okay. We got the visuals here on YouTube. All right. Now, to make sure, okay, let's take a look at the technicals here. I'm going to adjust. I don't have a double screen, so let me know. Let's see. That looks pretty good. Yeah, we're good right there. All right. So I'm going to keep it about right here. These are the cues. So let's take a look first. So remember, we're entering a seasonally weak period for the stock market, August into September. Usually you peak in July, right? Now, this doesn't mean every year, but on average, July is your strongest month at 1.7% upside, okay, for the S&P. And then you start to pull back and bottom in September. And that is weighing on investors. Investors are obviously like, hey, we had a big run up, right? Obviously, if you're overbought, then a lot of people are going to take profits. And that's what we're seeing. We're seeing profit taking. We're seeing a couple risks come into the market also. And so first, let's just take a look at the technicals. What are we seeing here on the actual technicals before we dive too deep, or before we dive into the actual risk hitting the market? So first thing I want to highlight here is we're looking at the cues, right? The cues, the Nasdaq, the tech stocks have been leading this market higher. We've led out of the bear market where, we got very overextended to the upside pretty quickly because the market priced in a lot of good things. It priced in the bottom of earnings. It priced in the Fed nearing the end of the hiking cycle. All right, it priced that in. It basically priced in the peak in bond yields. The problem is, out of all these things, right, and this is the run up of all these things, we are getting earnings starting to turn up. We are getting GDP turning up. We are getting the Fed nearing the end of the hiking cycle. They paused and then they came back on for 25 basis points. And, we're going to see next month if they continue to do that. But the one factor we haven't seen is bond yields peak. Okay, we have not seen bond yields peak yet. We have on the short end, but not the long end. So what I'm calling for here is we might be bottoming in the stock market. So first, let's take a look at S&P 500, right? Let's look at SPY. And what are we seeing on our resistance levels? Okay, we are seeing we've already broken through. So I got to change this color, right? This was S1, we broke through it. This is S2, we broke through it. So now we're headed for S3 at 431. Okay, we either bottom here or we make our way back to 431. So let's go ahead and change the color to a lighter color because now that is our resistance, right? Now 438 or 436 or 438 is now become our resistance level, and our last line of support is really the upside trend, right? We've had this trend for a minute. So I'm going to take this off. We broke this trend, right? So from the bottom of October, you can see that in October, we bottomed in October. Our second support, right? Our second support is what gave us that trend. Now you could draw this one, but I think it's a little more accurate to just draw the March lows because the March lows was actually, the banking crisis. So that's our support line. And you can see that we're actually pulling into that. So we dropped the 50-day moving average. Yes, we did drop the 50-day moving average, right? That is true. So we have the 431 spot to about 429, right? That's kind of where things got really overbought on the upside, or where we started to get a lot of momentum. So let's keep our eye on that 431 spot. The second support we have is the 100 daily moving average. That's our next support. The other technical factor, I think, that bottoms us out here, or signals the bottoming of the market, because I think we're going to see the bottom pretty soon here. We sold off sharply. I think we're going to bottom here, and it's the oversold RSI. It is the oversold RSI. Are we there yet? No, we still got to get to 30. Maybe we don't even get to 30. If you look the last time we had the RSI at this level, let me kind of give you a straight look at this, a horizontal view. So the last time we're here, right, we came down to, and this was March. This was the banking crisis, and we're seeing the same risks, which are interest rates are rising. That is hurting the banking collateral. Interest rates are hurting a lot of the funding for banks, right? They could fail. So that was the last time the S&P bottomed here. And we bottomed at on the RSI 35, right? We're actually at 35. Can we dip lower? Sure, we can dip lower down to the actual lower limit, but we're pretty much there yet, right? We're nearing the bottoming of this cycle, of this short-term, couple month cycle. Maybe we consolidate into August. Into September, we consolidate, and maybe August is pretty much the bottom. We could have one more slip down into support, but for the most part, this is what it looks like. This is the next area of support at 431. So what actually gets us to bottom? I'm pretty sure the only thing that gets us bottoming is going to be the actual macro forces starting to bottom. Okay. And that starts with the bond yields, right? Bond yields or interest rate risk has been the main narrative, right? Because the higher these bond yields go 30 years out, right? The stock market is measured, the crypto market is measured off of interest rates into the future, right? Long-term interest rates. They're called long duration assets because you're looking at interest rates into the future. These are 30-year interest rates. You could just put it that way, 30-year interest rates, and they're at the top of the range. If we break through this range, okay, S&P goes lower. Stocks, crypto goes lower for the most part. Nasdaq goes lower. But this could be the pivot. We could actually be looking at the pivot here, right? We're pivoting in the interest rate. Like there's a big short positioning in bonds. So if we look at TLT, TLT is also nearing, and TLT is a proxy for the bond market, right? Bond market crash, everybody's calling for it. And you can see technically we're at the bottom, right? We're near the bottom at least. And the last time we got here was October of 2022. This is where the stock market bottom. And this is where the bond market bottom, because inflation was no longer a risk, right? Inflation was coming off. It was very clear that the inflationary cycle had already peaked. And we know it still peaked, okay? It still has peaked. The problem is the economic growth is rising, and that's not really an issue, but the market is feeling a little bit of volatility because bonds typically sell off, right? Why own bonds if there is going to be no recession? Bonds are a protection against recession, but we're not seeing that. We're seeing stocks and GDP, well, the stock market, retain its earnings and GDP grind higher. So typically this fall in bonds was because inflation was high because, and then we bounced because inflation came off. And now what we're seeing is, well, if GDP is stronger than expected, we expected this move to turn back up, right? But if GDP is stronger than expected, why hold bonds? Why not if the Fed's going to increase rates because GDP is higher, because economic growth is still rising, and they want to make sure that inflation risks remain flat, okay? So people are selling off these bonds. It could be China too. It could be Japan. It could be other central banks or other big, large funds who are selling off U.S. bonds, U.S. Treasuries to support their own currency or to support their own bond market, right? We don't know the exact details, but what we do know is a weak bond market pushes bonds higher, right? And that's kind of the risk here. We're seeing mortgage rates rise. We're seeing, and really this might be the end of it, right? This is the pivot point. We're at the resistance level. So it's easy. We could easily just turn from here. The stock market bottoms. If this goes higher, stocks go lower. If this turns around, we definitely start to bottom in the Qs and in the SPY, okay? And now the second order effect is that when interest rates go higher like this, the dollar also bids higher because higher rates means the dollar is more attractive because you can earn yield off your cash, right? So the dollar becomes a little more attractive. On the flip side, if the interest rates are causing risk in the market because valuations for stocks go lower, the earnings go lower for stocks, then people kind of get scared. Like, okay, this could result in a banking crisis. If those interest rates are too high, banks kind of, some banks might fail. We get another banking crisis, or at least we teeter near a banking crisis. Therefore, the dollar becomes the safe haven currency. And I know people say, oh, the dollar's not a safe haven. Well, it is, right? It might be the worst currency in the world, right? I'm sorry, it might be a bad currency, the US dollar, right? It's still the safest currency. Nobody wants to own Japanese yen. Nobody wants to own Chinese yuan. Nobody wants to own Russian rubles or the rupee from India, right? People still want to hold dollars, right? The dollar's still the safest haven asset, despite what you believe. So the dollar is that safe haven, risk off flight to safety. And we're at the top of the trend here. So the dollar turning around is also our signal. So our main two signals here, right, on a macro scale, the macro forces are interest rates are peaking, 10-year yields starting to peak. The Fed is starting to, well, the Fed is probably pausing on this next cycle, right? The Fed is probably pausing in September because inflation isn't really climbing. We just had oil move up. That's about it. And when we flip over to oil, oil hit resistance. If it chugs sideways, well, inflation is flat. It doesn't go higher. If oil breaks out, we're in trouble. But right now, it's not breaking out in this immediate, right? In this immediate last, 30 days, 20 days. We're almost done with August. Oil's flat. Oil started off at 81, and we're pretty much at 81. That means oil or energy prices for this month have gone pretty much nowhere. That means CPI is not going to move up. Inflation is not going higher. It's flat. So I think we get in the 2.9 percentile for headline CPI given this backdrop. And if that is the case, stocks can move up. Stocks can find a bottom. If that is the case, bond yields will peak at this moment, right? Bond yields can now peak because they're, and what it is people can start buying bonds again, right? The bond market can start bidding up again. Now, the positive side of this, right? Not only are long-term bonds or bond yields starting to peak, because this is the risk to the market, higher yields, lower valuations, not only are they starting to hit resistance, and hey, if that resistance breaks, then yeah, we may go lower. But the probability of us going higher right away is lower on a technical basis. But when we look at the shorter term, right? Look at all this resistance we have for the short term. This is the 5-year yield, 5-year borrowing rates. We go to the 2-year borrowing rates. We're at resistance. We haven't broken this level yet. So the bond market is finding a bottom and bond yields are starting to find a peak. Okay, that signal of peak bond yields is the signal for the dollar to turn around, right? It's okay, we're done going higher. The dollar we can now invest our dollars back into risk, which would be crypto, which would be, that would be the most risk, which would be equities, right? Fixed income, whatever it is. So I expect the dollar to turn around at this point. Now, if it goes higher, risk comes back onto the table. But technically, right, I think we're going to turn around here, especially because GDP, it's not like we're at risk for a recession, right? The recession risks are pretty much disappearing as GDP goes higher, as we learn more about the economy strengthening. So the interest rate risks are really not there. And the second part to this sell-off, like I said earlier, right, as we talked about earlier, is we're simply entering a period of seasonal weakness, okay? Seasonal weakness. This is what it is, right? Historically, we sell off in September. This is the bottom. So most investors are going to be anticipating the bottoming happen in September, right? Sometime in September. They're going to be looking. What this means is fund managers, investors, they got the sell-off they wanted. They got the correction that they wanted. Some of you sitting in cash, yes, you want a bigger correction. You want more pain. But if that pain subsides, if the dollar peaks, if bond yields peak, if the risks come off the table, you're going to get a little anxious to start buying back in. That's not just you, that's market psychology. They're going to be looking for the bottom of September. Everybody wants to get the bottom. You won't get it perfectly, but September, everybody knows, is nearing the bottom. And when we do look on a technical basis, what do we see? Bitcoin dropped because of Evergrande. Good, Chavez, I'll address that in a second here. What we do see is the S&P is starting to find that bottom. Now, on to crypto, okay? Because you just asked about Bitcoin. So let me see, make sure we're on this chart. Yeah, we are on the chart. So again, like I said, look at the S&P 500, okay? It's just pulling back into its support zones. We're not even at the trend yet. We still have trend support. So we still have a little more room to fall, right? It doesn't mean we have to go that low, but we got this support right here. This is the major support at 431. And hey, maybe we bounce from here, get rejected, whatever it is, but we are at support still. When we look at the Qs, it's the same thing, right? The Qs are on the uptrend. We are just pulling into the trend. We have support, at 353 to 357. That's kind of the zone we called. The Qs actually might bounce before S&P here because Nvidia has earnings, and there's a lot of buying of those chips still. So I think the market already front ran earnings, right? They basically bought the rumor that earnings would be better than feared, and then the market sold off in the middle of earnings. So we could find a bottom here if Nvidia comes in stronger than expected. I think most of the market already sold. Apple pretty much sold off pretty strongly, right? Apple sold off more market cap than most stock sizes are. Sold off like 300 billion, probably more than that. Okay, so the Qs are pulling into trend support. The Dow is pulling into trend support, making higher lows, right? The Dow's pulling, let's draw the Dow support here, right? So Dow still has support. We're just pulling into the trend. We're not in a, we're not looking at a bear market here. We're looking at a bull market pulling into the trend, pulling into very strong support here for the Dow. For, IWM also looks like it's pulling into support. IWM is still pretty elevated here. So if we draw, it still has some room. It looks like it's kind of wedging, but we do have support. That's the main concept here, is that the market has not dropped any support yet, right? If we go to equal weight S&P, right into the trend line, right? This is, you take all the stocks in the market, you take the S&P 500 in equal weight, not just, not, oh, Apple's pulling the market, Microsoft's pulling the market, or Tesla. You equal weight all the stocks in the index, and it looks like market breadth is still holding trend. So we're in good shape here. Okay, now going to Bitcoin, going to Ethereum, right? Bitcoin had a sharp sell-off. Now I want you to check this out. Look at this RSI, right? The RSI signals to us oversold or overbought territory. And what we're seeing is Bitcoin is extremely oversold. It got down to 18. The last time we saw an 18 actually wasn't till March of 2022 or March of 2020. That's extreme. Now, this was a lot bigger of a sell-off or sharper sell-off than I would have thought. Okay, so the last time we came this low in the RSI, keep this in mind, was the bottom. It was March of 2020. All right, that was the bottom of Bitcoin. Am I saying today is the bottom? No, I'm saying as this RSI starts to recover, it's signaling, hey, that was the big sell-off in crypto, right? And 25, we're coming into the strong 25K level with Bitcoin also, right? This has been the strongest level. It was resistance back in August. Let's draw this. It was resistance back in August 1 year ago. It was resistance again in February. It bounced during the banking crisis. It showed 25K as support in June. So we have this as the most important, probably the strongest zone here at 25K. Now, could we capitulate down to 23.4? We could, but if we hold 25K here, then that's just another buy the dip opportunity, especially if the dollar is now starting to roll over, okay? Especially if bond yields are starting to roll over. So we got to keep track of that. As the dollar rolling over, our bond yields starting to roll over, okay? That's what's important right now when it comes to the macro factors. We know the economy is recovering. We know that China's a little weak, and guess what? China has, and I know you said China's weak, but here's the thing about China. China has they just cut rates, right? They cut their 1 year medium term loan rate. Now we're going to see on this Sunday in a couple days, if China cuts this rate, which is their 1 year rate. Are they going to keep cutting rates, right? Are they going to keep cutting rates? Yes, they're going to debase their currency, but they need to stimulate again. So that's what I'm looking for to China. Also, M2 money supply. Their money supply has been climbing, right, as they cut rates, and their central bank balance sheet also is starting to pump again. Okay, so that should pump Bitcoin. I know there's a scare and Binance and all this, but it is one factor for the upside when it comes to crypto in general. Okay, now looking over at Ethereum, let's make sure that I'm not missing anything. Yep, let's take a look over at Ethereum. All right, so Ethereum, same thing. Ethereum's pulling into support here. Wow, Ethereum actually dropped support at, 15? So Ethereum had a pretty sharp sell-off also. And if we measure the daily RSI, same thing. We came down to levels that we did back in June when we sold off to, 800? Ethereum made a low at 800. So last time before that, it was 2019, pretty much. This is actually a bigger daily retracement on the RSI than the 2020 levels. So Ethereum, that was the big, this is the big pullback. It could last a couple more days, right? But the RSI is pretty deep at this point. I think this is pretty much marking the bottom. I know people expect it to go lower, but that's not going to happen unless interest rates go higher, unless the Fed becomes more hawkish in their policy, unless the Fed keeps hiking, which is going to be a result of inflation climbing higher. And we don't really see inflation climbing higher, right? We don't see that happening unless we see the price of oil continue to climb. And then we're wrong, right? The oil does look still bullish. It still looks pretty bullish. It sold off and it is now recovering a bit. but it still needs to get above 83.50. Until we get above 83.50, it's not really a big risk to the CPI coming in September, right? Early second week of September, I believe. So that's not a big risk yet. If we get above that level, then we got to worry about it. But for the most part, we are finding support at these levels. The market is pretty much just oversold, right? Oversold at this point. So if we look at the RSI, and we're looking at a lot of the RSI signals, if we look at the dollar RSI, it's almost overbought, right? It's overbought, time to retrace. It's not there yet, but it's, you know, it's pretty close. It could be rolling over at this point. I think we're seeing some bearish divergence here on the dollar, which means price is climbing a little bit, right? And it's not that deep, while the RSI actually comes down. So on a technical basis, I think the dollar is pretty much done, unless we see another, right? Unless we get some more news that causes more panic. What about bond yields? Well, the 2-year is pretty flat. So short-term funding is, you know, pretty flat at this point. Still elevated, but pretty flat. 5-year, whatever, 10-year has been climbing, but that RSI is also hitting the top. So we're actually this is actually bearish divergence. The RSI is moving lower, and the price of, I don't want to say the price of bonds, but the bond yields are moving higher. So bearish divergence. I think this is a pivot. I think the market can definitely bounce here, and you have more bearish divergence on the 30-year, right? The 30-year rate. So there's a little panic going on there. And then when we move to the bond market, what are we seeing? We're seeing on the bond market, we're seeing some bullish divergence, okay? People buying this bond market. And what that is you see we made a low for the RSI. Let's get this correctly. We had a low in the RSI back in, you know, the 3rd of August, so early August. And what that looks like is you have you know, buying pressure picking up. So actually there's more inflows coming into the bond market. There's actually more inflows into the bond market. I know there's some Bank of America research that showed that, while at the same time, the price is falling deeper. So that's bullish divergence, right? The buying pressure is picking up, inflows are picking up while price is still falling. So I think over the next, you know, maybe over the weekend, I think we definitely get a bounce and we consolidate a little bit. And I think we can bounce from here. All right, now moving over to, actually let's check the questions. Any questions? Yeah. So Bitcoin dropped because of Evergrande. Not exactly. That does pose some risks, but I think Bitcoin, also there's some Binance news about Binance being sold. It's just a lot of fear, right? A lot of uncertainty. It's not, you know, it's trying to price in the worst scenario. And that's why we had a big bid in Bitcoin. It's trying to price in the worst scenario. It's not like Bitcoin is oversold right now, or I mean, it's overbought. We're not seeing overbought territory for Bitcoin. It's mostly, or for crypto in general, it's mostly like, okay, let's price in the worst scenario and then track, is it really that bad? If it's not that bad, Bitcoin should recover, especially right into that 25K level. Okay, now turning to Tesla. Tesla's starting to hit our upside price targets here. It is selling off pretty sharply. We know that. But we are going to, let me see, make sure we didn't miss anything up here. No, I guess not. Okay. If you have any comments, just let me know. So taking a look at Bitcoin. I'm sorry, at Tesla, right? Tesla, same thing. It's oversold, right? We're pulling into the trend. So this is the trend for Tesla, right? It's pulling into the trend pretty nicely. And we're now down to where we were on that sharp sell-off. Well, we're not exactly there, but you know, when you do get these oversold signals down here, that usually correlates with the bottom. Now, you got to be careful with Tesla. If there's bad news, it could dip a lot deeper. At first, it has to come up. It has to retrace. So I think we're going to get a short-term bounce here. My guess is on Monday, we're going to be back above 225 for Tesla. I think we get back above 225 on Monday. Let's see, where's 225? Somewhere around here. I think we get back above that, and then we'll see if we can break this downtrend, because currently we are looking at a downtrend for Tesla, a really sharp downtrend from earnings. This is the downtrend. Maybe we can break that downtrend or test that downtrend somewhere around here, Monday, Tuesday, Wednesday. And then from there, we got to say, okay, our bond yield's starting to roll over, right? Is the cost of capital coming back down? Is the dollar finished going higher? If it is, we might be able to hold these levels. If not, then Tesla is going to go retest. You know, would it hit 214 today? 213 is going to come retest these levels again, 212. But it is extremely oversold, and it usually bounces back, you know, pretty sharply when it gets this oversold. And we're still holding the trend. We're still holding the uptrend. All right. And, I know China's weakness is a worry, but China is going to have to stimulate at some point. They always do, right? They're good. They're lead the economic cycle. They're not as strong as we thought. And now they should be boosting higher. Here's the other positive, right? The market is, this isn't like a huge positive, but what it tells you is the market's expecting the Fed to pause here. There's a 90% chance, the market is betting a 90% chance that the Fed does not hike in September, that it holds rates at 5.25 to 5.5. That's the bet. A 10% chance that they do hike rates by 25 basis points. So we got to keep, obviously we want to keep this into our purview, or factor it into the analysis, factor it in to, technical analysis, macro analysis. If this changes, if this really comes down, that should signal more weakness for the market, because now the market has to price in higher yields, right? Higher interest rates. And that is going to cut valuations a little further. I think the Fed pauses at this point, right? Unless oil starts to surge, I think the Fed's going to pause. Now, when's the next rate cut? Where's the market looking for a rate cut? Is it December? No, it's not November. It's not December. January. We're looking for the first rate cut. Nope. March of 2024. I think here's where it is. The market is looking for. Actually, it still has a pause here in March, but this is where the rate cuts start to come in. Is March of 2024. And I think this is good. The further out the market sees rate cuts and still holds on, that's good. Because if the Fed does happen to cut rates because inflation is making more progress, that's going to be an upside surprise for the market, right? Right now, the market's looking for a cut in May, right? In May of next year. So not for another 10 months. If these cuts start to, compress to shorter time frames, because that's what, 10 months out? If they compress down to March or January, the market should bid higher, as long as the reason for the cuts to be shorter. I'm sorry, as long as the reason for the cut earlier is about CPI coming down, inflation coming down versus recession. Okay, so it's all about, is the Fed going to cut rates or ease policy or be more dovish because CPI is making progress, because inflation is making a lot of progress, or is it because there's a banking crisis and everything's falling apart? So those are two distinctions when we do analyze, okay, how is the market going to price in the Fed going forward? All right, so those are the things we're kind of looking at there. And there is some seasonally, again, we're looking at a seasonal weak period. There's still a lot of strength here. Earnings should be bottoming. I think that's the best signal we have, that earnings are bottoming here. And there's no reason there's a couple of reasons, like black swan events, but there's no reason to get hyper bearish until we see bond yields hold above that level, and until we see, the dollar really start to break out, and for some reason there is real banking risk. So we got to keep our eye on that. Let's get some of these other ones. People in China are selling risk for dollars. Okay, that makes sense. Chavez, there was a report that, and let's go to the dollar really quick, because this is the key macro factor right now is the dollar. It is interest rates, but the dollar gives us a lot of insight. Okay, so it looks like, there was a report that said that the People's Bank of China was selling what were they selling? They were selling dollars. Some people are saying they were selling dollars to buy their own currency. Who knows? But I think people are selling Chinese stocks, because now the risk of recession is coming back, right? There's not a whole lot of legs for the Chinese economy unless they cut rates, unless we start to see that evidence. They remove the youth unemployment rate, and demographics are terrible. So China is struggling. So what are people doing? They're going to the dollar. They don't want to hold the US yuan. All right. So yes, Chavez 100%. And then we have Slime Z here. Maybe for Tesla, maybe touches 200 EMA, 190 area, but I doubt it for Tesla. If it does touch 200 or 190, I think we first need a bounce, and then it goes back down. So I think we're near the bounce. I'm pretty sure we're near the bounce. Maybe on Monday it slips one more time, and then it bounces, right? And once we get that bounce, then we look to, are the macro factors or the macro forces going to support this bounce? Okay, the macro forces supporting this bounce. Are there any bullish or bearish catalysts that can take Tesla higher or lower? Is the overall market, strong? Is it supporting Tesla with the support, or is it supporting Tesla rolling over? So Those are the three factors I'm looking at: macro forces, overall market, and then individual catalysts to see if Tesla goes lower. All right. And then we have Chavez. I think they during like they cut during elections. Okay. You think they cut during elections? That could be very possible. I'm still factoring, like, maybe we don't cut till, summer next year, but I think that the Fed, because we will, the question is, will the Fed sacrifice GDP? Will they sacrifice, not GDP growth? GDP growth. Will they sacrifice GDP growth and possibly an unemployment spike by not cutting rates when inflation gets down? Because you got to remember too, a lot of GDP is coming from inflation also. So inflation fuels GDP growth at the same time, right? The question is, where's that medium ground? Is it 3.2? Is it 3.5%? Where does inflation need to be? And then what inflation are we looking at? Headline? Or are we looking at just core? Are we factoring both? Headline's going to get down to 2.5 by the end of the year, right? Headline inflation will be lower twos by the end of the year. The question is that enough for the Fed to cut, right? It is enough for them to pause. Is that enough for them to cut? Maybe, maybe not. Where does core need to be? Where does core, it's at 4.7 right now. Where does core need to be for the Fed to cut rates? All right, where does core need to be? And so far, the market's not pricing in cuts till next May. That's not terrible. The expectation is further out. So if that expectation comes into, let's say, March, January, I think the market can bounce off that because it is expecting better valuations going forward if that's the case. So we just got to keep our eye on the bond market to see, are we getting more interest rate risk in the bond market? How is that playing out? Okay, just a bunch of ads there. All right, cool. So yeah, it's Friday. It's Friday. We're getting that bounce. I think we're just a little oversold. Recession is better than higher for longer. Chavez says recession is better than higher for longer. I would say that it depends on what type, how bad the recession is. Is the recession better than higher for longer? There's a couple ways this can go. If we do get a recession, right, and what does that look like? It's not going to come all at once. We need to see unemployment spike. We need to see jobs go negative, right? We need to see the jobs market or payrolls actually start to go negative if we're going to get a recession. We also need to see GDP come back down. Like, GDP is nowhere to be seen coming back into the negative territory. Right now, it keeps getting revised higher. So could it turn? Yes. I know there's student loan repayment coming up. Okay, that should put a negative effect on growth. I know we have a lot of defaults for, a lot of defaults in for vehicles, right, for current loans. But you also have a lot of income for the baby boomers. You also have a lot of fixed income coming into the market. A lot of fixed income from dividends. A lot of fixed income from the bond market. A lot of fixed income from real estate. So, home prices are still elevated, and those prices are literally feeding real estate investors who are holding those houses. Now, if you're underwater, you're underwater, but you're getting fixed income either way. So I think it kind of neutralizes itself. And the real question is, will inflation come down? As always, if inflation does make its way lower, well, that leaves people with a little more buying power. And we've seen that. If inflation comes down, it also means the Fed is near, lowering their rates. It also means the bond market can lower the cost of capital. So it's really, it's not really like a linear thing. It's a very explosive in either direction. We just had a big move lower because now, oh shoot, capital is tightening, right? The Fed might hike rates a little more. GDP is up, we know that, but the market's already overbought anyway. So now we're just getting that reversal. The market is now selling off a little bit, and I don't think this. I kind of like this setup. I really do. This is where the opportunity is, right? If it was easy, people would have bought the bounce earlier in the year. They wouldn't be waiting. So again, it's scary because like, do I buy this bounce? Is this the bounce to buy? I don't know. Let's look at the VIX. Okay, the VIX is back. The VIX made new highs. So yes, that is a cause of warning, but it's near resistance. So the VIX is near resistance. Now the other side of it, the volatility of VIX is also starting to turn up. And what this means is VIX is just, volatility in the market, but this is actually the vol of vol. They call this the volatility of volatility. So it may be trending up again. And I think this is all because of the, more banking crisis worries. So let's draw this trend, make sure we know that it's definitely something we want to watch. Okay. And we're at that, I don't know if moving averages really matter on, volatility, but either way, the VIX is not spiking considerably. or significantly, it's just showing some strength because more uncertainty, right? Also, people are buying insurance because the market was overbought. It was overbought, so it needs a pullback. All that cash on the sideline should come back in. Nasdaq volatility actually fell. I think this is a signal for tech stocks to start leading again. I think we're going to see tech start leading again. I'm looking for the strength in the Magnificent Seven, right? Amazon, Apple, Google, Facebook, Meta, Tesla, Nvidia, and Nvidia earnings are going to be very important for that factor to take place. All right, so we're definitely watching that. Here's the negative too. Triple B spreads or credit risk, equity credit risk is rising. This is what this means. When it goes up, equity credit risk is rising. When it goes down, credit risk goes down, right? Credit risk is falling. Triple B spreads, basically, the spread between treasury debt and equity debt. And so when it goes up, equity credit risk is rising. So it's rising, but it makes, it's not spiking yet. We do know that there's some caution there. So we're going to look at the technicals to see if that turns around, right? The yield curve is also starting to reinvert, right? The yield curve is, I know people signal, oh my God, the yield curve is you want to take the log off when you measure this. The yield curve is coming back up, right? So it's starting to uninvert. It's starting to uninvert and normalize. This is usually where you get the recession, when the yield curve goes back up. And all that means is 30-year rates are rising against short-term rates. Long-term rates are rising against short-term rates. So this hurts long duration assets like, technology and crypto, but it does not hurt necessarily GDP or economic growth, right? So again, you have a really balanced headwinds and tailwinds. Right now, headwinds and tailwinds are pretty balanced. And that's why I think we could just move sideways, right? But the biggest factor is CPI. The biggest factor is what is the Fed going to do? And the biggest factor is what are earnings going to look like? Earnings look to be going higher, right? GDP is revised up. Earnings are going higher. Now it's up to the Fed and inflation. Is the Fed going to pause? Are they going to be more hawkish? Probably not, because the bond market's doing its job. It is tightening financial conditions without the Fed. That's what it needs to do. So I think the Fed pauses right here, right? Next is, you see bond yields, stock market earnings, is inflation. What does CPI look like? And that all comes down to oil prices. Are oil prices going to peak out here? I don't know that. We cannot guess that. But global demand, look, here's the positive. Here's why I think this is still a buy the dip scenario. Here's another reason. We know China's weaker than expected. What does that mean? That Chinese, or not just Chinese, but China's global demand for oil is really non-existent. I don't think we get above 83.50. I just don't see it. I know the U.S. economy is recovering, but it's mostly happening in the services sector. So, and seasonally, we're done with the big demand zone for the U.S. India does not have demand during the season. So I think oil will stay tame, and I think CPI is in our favor. I think the Fed is in our favor. I think earnings are in our favor. The biggest non-favor is that, hey, the dollar has been moving up pretty rapidly, and bond yields are moving up rapidly on the long end, which is causing, bond market risk. But here's the positive. We're not seeing bond market volatility spike. So again, I think it's just investors are collecting profits. They're collecting profits, and they're looking to rotate into something that hasn't moved yet, as long as these yields come down. So I think we're just looking for a bottom here. What else we got? Sorry, I only got one screen today, so I can't navigate that good. Okay, yep, that's what we're looking at. So let's look at sort of the sectors. Okay, let's go through the sectors. What sectors moved higher today? I know today's Friday. You usually get a big red day. And it looks like we have industrials moved higher today. Okay, industrials moved higher today. So industrials at least had a positive day, right, after gapping down. Healthcare consolidating, still above the moving averages. So healthcare looks straight. Utilities look ugly. They're pretty much falling apart, but they did have a green day. They recovered today. Consumer discretionary, okay, started to bounce a little bit. Still above that 100 moving average. Looks the same. Consumer staples, defensive stocks look pretty nasty. They could be bottoming. A lot of support for consumer staples, but they are below the moving averages. And that just means defensive stocks are not that appetizing, and why would they be if there's no recession? These are defensive stocks. These are stocks that usually catch a bid or demand whenever economic growth is slowing, but that's not the case. Okay, consumer, what is this? Communication services. Okay, they have broken down, but there's still, I still think there's a lot of room for services to hold that bid. I think the last time we came down to the 100 was March. Everything is March. I think we're just retracing to the March trends at this moment, right? Back to the March trends. And remember, the March was all about interest rate risk. We're entering that again, but it's not because of inflation. That's the key. It's not inflation that's causing interest rate risk. It is higher than expected growth, which is causing people to get out of bonds. Therefore, interest rates go higher. So it's kind of a weird scenario there, right? How about financials? Financials are still holding the uptrend. Energy is pretty strong because obviously, we got that bounce in oil, and energy companies also are not just invested in oil. They're invested in other renewable sources. So these companies are a little more well-rounded because not only do they benefit from higher oil prices, but they're also going to benefit from their investment in solar and nuclear energy and other renewables. And they're looking to get some stimulus from the government for that Inflation Reduction Act. So, energy should do pretty well. That'll hold up S&P earnings going forward too. Basic materials. Okay, so materials, building materials. I think these continue on the uptrend because you got the infrastructure bill, right? Caterpillar, a lot of companies are benefiting from that, industrial companies. Real estate, I think, is probably in the worst position at this point because mortgage rates are way too high. Mortgage rates are too high. There's not a whole lot of demand for real estate. And so I think real estate moves sideways. I'd say this is the weakest sector in the S&P. Other than defensive stocks, I'd say this is the weakest sector. How about home builder construction? Home construction up a little. It's pulling back a little bit, but it's been strong lately because there's a lot of demand for multifamily homes, and that ETF is benefiting from that. So there's a lot of demand there. How about chips? Right, this is the chips. This is semiconductors, SMH, the semiconductor ETF. Very sharp pullback. It is falling into support. So we'll see. Nvidia is going to make the big difference here. Nvidia has earnings next week, and that's probably that's the last mega cap that needs to report and sort of give us a look forward into, okay, is AI really that? We know we had a lot of hype on the last report from Nvidia. Does that carry over to the next report? Right? Does it? Regional banks. Still on the uptrend, but they could be slipping here. We really don't know. They could be slipping here. So it looks like that's what that's ahead of us right now. Now I will have the report coming out this tomorrow, right? I will have that report out tomorrow. If you want to hear my thoughts or just kind of see what I'm looking at, I think we're just going to pull back. Do you think oh, there we go, tech stocks. Okay. Do you think tech stocks will die out, then transition to a different category? I don't think so. I don't think tech stocks will die out yet. And the reason I say that is, let's take a look here what we're seeing. So right now, tech stocks are under the most pressure because of high interest rates on the long end. Okay. So just keep this in mind. If this turns around, tech stocks are going to be on their way back. And the reason we got to keep this in check is because, long rates were not climbing, earlier in the year. It used to be the short end rates, right? Short-term rates were climbing faster. Therefore, tech stocks were like, okay, well, long rates are low, so we can bid up. But now that has reversed. And we reversed that. Long end rates are climbing higher. Thanks for the love. I appreciate you guys for the likes. Long end rates were going higher, so that hurt tech stocks. Plus, they just ran up too much. Okay, now we're in the pullback. So I think the rotation has happened out of tech. Some people are talking about the continuation out of tech. I really doubt that continues. That's never been the case for the last 10 years. For the last 10 years, it's been Apple, Amazon, Microsoft, Google, Meta, Tesla, sort of, right? Tesla kind of broke out in 2018. So I think tech continues to lead the rally. They've just sold off, right? And this is all contingent on will long-term rates start to slow down again, right? Will long-term rates start to slow down again? And also that has to do with CPI. So no, I think there could be a rotation, but at the end of the day, there's a lot of infrastructure spend inside of chips and technology, and I think government spending around the world is going into AI. It's going into chips, and that government spending should support the best companies, right? It still should support the best companies. Apple's almost bottomed in its earnings. Probably the next report it would have bottomed. So that's my view on it. I think tech would be fine. And two, let's look at the technicals on the Qs really quick. We're pulling into the trend. It sold off a little faster. Okay, looking at the RSI, we're almost back to oversold. And the last time we got this this deep was the bottom. Okay, so keep that in mind. The last time the Qs came this far down, it was the bottom in January. Well, it was really October and January, right? Those were the two bottoming signals. So this is the biggest sell-off we've had in the Qs as far as buying or selling pressure. This is the most selling pressure that we've had in the Qs, and we're still in an uptrend. It's not like we're in a downtrend. Probably since really the beginning of the bear market, right? The beginning of the bear market. The difference is we're not entering a bear market. We're not entering higher inflation. We're not entering lower GDP. We're actually, it's the reverse. We're getting lower inflation, higher GDP, higher growth. So the Qs are just cooling off. Nasdaq tech stocks are just starting to cool off at this point. In my view, we're still holding that uptrend. We're still holding that uptrend. And the only way to really grow your GDP is by productivity, and you need tech stocks to grow productivity in the first place, right? You need technology to increase productivity, because that's the only way to really grow your earnings. And what you do is you have less jobs. The less jobs there are, the less wage inflation, and the jobs kind of switch off. But you have less jobs not available. You fill those jobs that need to be filled with AI. Therefore, you produce more supply, or you fill it with some type of technological advance. Right now, it is a lot of AI, blockchain. You're seeing a lot of blockchain happening. Visa's using a blockchain. There's a lot of institutional banks that have their own private blockchains people don't know about, and they're using these blockchains to increase the efficiency, settlement times between transactions, and that actually helps your GDP. You cut out middlemen, that helps your GDP, right? So I think that tech is going nowhere. It's definitely appreciate it. Thanks for the love, man. User 67285. It just comes down to we're just oversold, right? Positioning is the story today. Today, the story is everybody was a little overpositioned. They were overpositioned. Tech got way too, I don't want to say it's way too overbought, but it got pretty overbought. I mean, we went up into the overbought levels pretty sharply, a lot faster than Nasdaq, a lot faster than S&P. And we made a lower high. That was kind of the sell signal. If we couldn't hold the support, we couldn't hold it. So now tech is just selling back off into the trend. I think we're still holding the uptrend. Okay, we are still holding the uptrend. We have the Dow still holding the uptrend. We have IWM still holding the uptrend. You have equal weight still holding the uptrend. Hey, why is this? This should be, let's go back to the log. Okay, it should be on a log chart. We're still holding the uptrend, okay? This is the bottom, like I said. I'm not saying this is the bottom, but this is where the bottom would be if you are trying to get a very good entry price or an entry, right? And trust me, all the fund managers are watching this. Like the RSI is already bouncing on the S&P equal weight, right? I'll have more charts available on the macro newsletter. Make sure you subscribe if you're not. It's free. Link in the bio, link in the description. Okay, I'm going to have a little more information. These are the technicals. If you guys want to look at the technicals, this is why I do them here, because charts don't do you too much service. You can't really, it's not like it's a moving chart. Like if I show you a chart, it's kind of just a snapshot, but I like to do my technical analysis live. It's just a little easier to understand when I can move things around and point out what I'm looking at. But most of the macro stuff, the sentiment, all the other charts that I get, that's going to be in the newsletter. So go ahead and check that out if you're interested. Maybe it'll supplement your trading, help your trade decisions. So far this whole year, we've been pretty correct that we're in a bull market and that we're moving higher. And so maybe you want to, doesn't mean I'm going to be right forever. I still think we're there. And, the biggest factors are Bond yields may be peaking here. The Fed is done. They're done with their hiking cycle. I know people say, well, the Fed might still keep hiking. Only if inflation goes up. 25 basis points, not a big deal if GDP goes higher. That's what's important to understand. If the Fed hikes 25 basis points, it's not because inflation is reemerging. It's because GDP growth is higher. And that's not a negative thing either, because that means people who don't hold a lot of debt, who hold a lot of cash, like Berkshire Hathaway, like, a lot of people who save a lot, they're going to earn more on their cash. That is a positive to the market. That means they can reinvest that cash into the market, or they can spend into the economy. So it's really a net positive here. The biggest factor, as always, is inflation. If the economy happened to fall apart, the Fed can cut rates. They can easily turn this boat around. But if inflation goes higher, that's a different problem. That's a much tougher problem to deal with, which is why we did sell off in the first place, right? At the end of 2021 into 2022, because inflation was too high. The market saw, okay, we're going to get higher rates from here. The cost of capital is going to go up, and we're also going to we're going to pay higher, supply prices to run our business. So that's what kind of sold off the market, right? But that boat is turned around here, and people are a little anxious to get in here. I think there's a lot of anxiety to get back in the market, even though people call for a deep recession. It just doesn't seem like that's going to be the case. How do you feel about investing in Ford Motors? To be honest with you, trash. Compared to Tesla, trash. They have terrible balance sheets. They're not really making a lot of money. They hold way too much debt. Fundamentally, most of these companies are trash. VW is okay in Germany. VW is not too bad. Also, think about it. As we transition into the electrical vehicle, or electrical vehicles in general, as we transition, a lot of Ford and GM and a lot of these, traditional automakers, they have a lot of inventory, they have a lot of inventory that they're not going to be able to get rid of, right? Gen Z and millennials, they're not necessarily going to be the big buyers of gas vehicles, of ICE vehicles. They're going to be they're going to turn to electric vehicles because the cost of electricity is falling. The cost, and I know people disagree with this. This is my thesis. This is what I think. The cost to drive EV is going to be better. It's better technology in general, right? It's going to cost you less as we get energy storage online. So going forward, you might bet on Ford for the next 3 months, the next 6 months. It could go higher. But secularly, you might get a couple of earnings reports where it tanks, and you might get a couple, or maybe it just stays flat. You might get a couple of earnings reports on Tesla where it just explodes again, right? Because they are the leader in the EV revolution. It's not just EVs. Tesla also has robotics. They also have energy storage. That's huge. Solar roofs, right? Solar tiles sucking in that sun's energy. They got the mega battery packs that can conserve that energy. The technology is not matured yet, but that's what you're betting on the future, right? The iPhone wasn't here yet in 2001, but when it got there, Apple, kept chugging higher. Apple is now the most valuable company because of what they could be, not because of what they are, because of what they could be. They led the mobile wave. They led the mobile era, and Tesla is leading the energy storage era. There's a lot of whole positives for Tesla, and when it comes back for 25%, that is a good opportunity. I'm not saying, hey, Ford is trash for a lot of people. Maybe, it pays a dividend, but I just know. It depends. Are you a growth investor? Are you looking for growth? Ford is not there. GM is not there. If you're looking to be safe, well, are you safe investing in a company that may fail in the next couple of years, who's getting their inventory is getting eaten up? They can't innovate on time. And if they do survive, guess what? They're going to have to buy, or they're going to have to use Tesla's autonomous vehicle network at some point, and their supercharger network. So my opinion, Ford is trash, right? Doesn't mean in every situation, but if you're looking for high growth, it's not there. What else do we say? XUSD on Sunday night, holding for easy profit. Sounds like LFC. You're looking for gold. Yeah, I don't know. Gold is a poor man's Bitcoin. I think at this point, it's a poor man's Bitcoin. So I know people like gold, but you need the Fed to really debase the currency for gold to go higher. I always say this, and even if they do that, Bitcoin's going higher than gold. So if you're worried about Bitcoin and gold safer, well, you don't hold physical gold, right? Usually you're buying some ETF where you can't even track if they actually have the gold or not. So I still think Bitcoin's a safer choice. It's easier to look on the blockchain to see exactly what's happening. That's just my opinion. You know, people disagree, but yeah, gold selling off because I mean the narrative for gold is slowly falling apart. It's the best narrative for gold was always a store of value, right? A store of value is the best narrative. And at this point, it's kind of overbought. Like the market is $10 trillion. Bitcoin's, the crypto market, well, crypto is not Bitcoin, by the way. It's not the same. Store of value is not crypto, it's Bitcoin. So Bitcoin in general, that is a $500 billion market versus gold is a $10 trillion market. So who has more opportunity going forward? Bitcoin. A lot more a total addressable market for Bitcoin. Gold has pretty much peaked out in my view. But I am looking for the Dow. I am looking for the Dow to hold gain. I'm not really a Dow guy, but I'm looking for the Dow. Last time when we had the Dow break out, it kind of came lower. Then we transitioned into tech. So I think this sell-off is pretty much telling us that, really everything is just pulling into trend. Everything's pulling into trend. So I expect, value stocks. What do we got? Caterpillar. Caterpillar. Look at Caterpillar starting to wedge here. Caterpillar's wedging. Got the wedge on Caterpillar, looking pretty nice. Yeah, I think we're right on track. It's just, if you're a little fearful, just take this in mind. Like the Fed is, set. The market is pricing in a hold. It's pricing in the pause. Is the more material, the more this materializes, the better. Also, China is stimulating. They're cutting rates. Okay, China's stimulating. They're cutting rates. Let's look at the EU. Inflation is falling in in Europe, right? So if you look at the Euro area, they call it, inflation is falling in Europe. It's not going higher in general. Okay, so they're starting to recover a little bit. Europe is recovering from the inflation fears. Core inflation in Europe is still a little sticky. Okay, but again, shelter is a big component of that. So I'm going to give you guys my thesis in a couple seconds if you have nothing else to add. The housing market in the US is starting to recover a little bit. But I'm going to tell you why I think we're still headed for all-time highs. Your thoughts on AMC? I'm sorry, I'm not an AMC guy. I think AMC is all hype, right? Everybody got hyped up on AMC and GME going higher. It was all a technical trade. They have no long-term value. Maybe I could be proven wrong, but compared to all the other AI, artificial intelligence, blockchain, technology, energy storage, robotics, software, what does AMC do? What do they do? Okay, and I'm making the case that AMC, people are only attracted to it because of the movie they're coming out with on AMC, because AMC, basically had a big short squeeze, and what that was is so let me show you guys this, because this is why AMC went a little higher. I'm gonna go to something where you can actually find these short squeezes. I doubt it's gonna happen again anytime soon. What the heck is this? No, I am not trying to add anybody on this live. So this is why AMC went higher. Basically, there's a metric you can see called short interest, right? It's right here. AMC has 26% short float. What that means is institutions are shorting AMC. Whenever institutions short, they're selling the stock. They borrow shares from a bank and then they sell those shares down. That's a short, okay? So back in the day, AMC and GME were pretty much had the highest short float, meaning almost 100% of the stock that was trading was short. Everybody borrowed the shares, the institution, the hedge funds borrowed the shares, and then they sold the shares. So Wall Street Bets, what they did, they saw that, and then they can't match the hedge fund liquidity. So what they did is they bought call options, because when you buy one option contract for a tenth of the price, you essentially still own 100 shares. Therefore, the banks had to go buy 100 shares to back the contract. Therefore, the banks are buying against all the shares that they sold to the institutions. What does that do? That pushes price higher. Artificially, the institutions are like, okay, at some point, we're going to have to stop out here. They start stopping out, boom, boom, boom. and the stock just has a gamma squeeze because when shorts cover, they have to buy back the stock. So you get traders coming in, you get call options coming in, and you got sellers selling or buying the stock back, and it causes a short squeeze, right? That's the only reason AMC had the big run. That's the only reason people even are interested in AMC and GME. Other than that, they're really not, long-term holds. There's nothing special about AMC. There's way other opportunities. You got Palantir, best software company in the world by far that, is unrealized. You have crypto as a sector. Most cryptos are trash, by the way. 90% of them are probably going to zero. But there's other opportunities, right? And that's if you're looking for high growth. If you're looking to preserve capital, well, U.S. Treasury bonds are going to preserve your capital. They're backed by the U.S. government. They're never going to fail. The Fed will step in at some point and buy back those treasuries. They're going to pay a dividend yield, and the underlying value goes higher. So if you're looking to protect capital, look to the government bonds or find a dividend stock. But dividend stocks are tricky. Look at Verizon. This is one of the best dividend stocks, but it just keeps falling. There is no bid for Verizon, right? The government's not going to come in and buy Verizon, but they will come in and buy government bonds. So TLT might be low, but government can come in. The Fed will come by. The Fed's not going to buy Verizon. They will buy TLT. They did it before, right? That's the difference. That is the difference. So to preserve capital, bonds, even cash right now can help because you can earn the yield. But I'm guessing you guys don't have like $5-10 million. So you're really looking for growth. And you're only going to find growth in technology, Nasdaq, or crypto, in my view. And that's not always true. There's some other plays, but like where you don't have to like watch it every single day. Those are the biggest moves there. All right, where are we at with the stream? Okay, we're at about an hour. See, closing thoughts. Yeah, let's get some closing thoughts here. I'm gonna definitely tell you guys what I think is gonna happen here going forward. Inflation, right? CPI. Let's go to CPI real quick because this is the most important factor. No matter what you hear on the news, oh, inflation risks are going high, mortgage rates are climbing. This all depends on the inflation outlook. So let's go to the US CPI. And if you're on this website, you could just literally click on anything. Actually, let's go to, let's see, US inflation rate. Okay. US inflation rate. And this is what we're looking at. We had a bounce for the first time. Okay. Inflation. I mean, look at the trend. Inflation is falling like a rock. We just had one bounce and everybody's like, oh my God, inflation's going back to the highs. Bro, it was one bounce. Okay. And here's the thing, that bounce literally came from, okay, this is the thesis. I want you guys to understand this. Came from oil prices surging, right? This box right here, this orange box, if you guys can see it, this was oil, the biggest input to inflation, climbing higher in the month of July. Okay. That month of July CPI print comes in to the August reading, which we just saw. Okay. It's not the August reading. I'm sorry. The date that we get CPI is in August, but it's the July reading, right? So July CPI bumped higher because literally because crude oil went higher. The other factor here is that the other biggest component to inflation, so we know oil is coming lower, is shelter. Real-time shelter is collapsing, right? Zillow, Redfin, even the Case-Shiller, which is all metropolitan areas, that inflation is coming down. Not the prices, right? Inflation is not the absolute price. It's the rate of change of prices. This isn't the economy we're speaking of that's going to get better because inflation is stuck. This is the stock market. The stock market wants to see the rate of change come down, not the actual price, because the actual price actually boosts stock market, right? If the prices go up a little bit, well, that means companies are going to earn more off of their sales. Okay, so that doesn't hurt the stock market. What hurts it is the rate of change going up too quick. All right. So the rate of change is coming down for inflation. And that's why stocks have been rebounding for the last 6 months, since October, because we peaked in inflation, right? Now, the big next component to fall is shelter prices. And, we're due for that fall. So I think still we're going to see more of a collapse here. Yes, CPI looks like it's turning back up, but it's just one retracement. We had a record 12-month fall in CPI. Now it's time to turn up a little bit because the base effects are in. And we're not going to drop as fast as we did unless oil really tanks. And then when that shelter price comes back into the market, the Fed is near pause, right? Jerome Powell said And he's been saying, hey, we're seeing progress on inflation. They are saying inflation's too high because they have to say that it's core inflation held up by shelter. But he said, hey, we can actually hike rates. We can cut rates if we see CPI fall towards 2%, not at 2%, towards 2%. Now the question is he talking about headline or is he talking about core? Core is a little hotter than headline right now. All right. So those are the catalysts. Here's the other part. Earnings. The market runs off of earnings reports. And right now, GDP is being revised higher, right? If you could check out, you can go check out my Twitter feed. I'm always posting things. So if you look at headline growth right now, Atlanta GDP got revised up to 5.8%. This will be in the macro report if you don't want to listen, right? 5.8% it got revised up. That's going to translate into earnings for stocks. That's going to make earnings go higher, okay? So you got earnings going higher. You got CPI coming down as long as oil doesn't get above 83.50. And you have, a lot of cash on the sideline ready to get back in, FOMO, as we called it over, when S&P first broke about 4,200, that was the FOMO level. So who's set to do, what are some of the stocks that are very behind, right? What are some of the stocks that are very behind here? I think it's Zoom. Zoom has an earnings report coming out in about a week, right? Or actually, wait, is this sooner? This is sooner than I thought. Yeah, this is 3 days. Okay, nice. So we have Zoom on Monday, right? Oh my goodness, this is sooner than I thought. Zoom has been holding on here. Zoom has a long way to go. My sources tell me they're going to come out with some AI stuff. They're going to come out with some AI talk. They have not recovered yet. This is one of the names that hasn't recovered. I think Zoom has a long way to go, right? Teladoc also is using AI to increase productivity for healthcare. Healthcare is always going to be needed. If you've ever used Teladoc, it's really easy. You just take a video conference. Who wants to go to the doctors and wait in line? You could just literally get a hold of any doctor, get your prescription, tell them your issue. Teladoc has a lot of promise. It sold off a lot. Also, ARC sold off, so that pulled down Teladoc at the same time. So Teladoc at the lows, right? At the lows right now, I think has a lot of promise. Obviously, Bitcoin, Ethereum, Tesla. This is just, this is what I think. So test me again in about 6 months. We'll see where these are at. Teladoc, Zoom, Tesla, Bitcoin, Ethereum, Chainlink, whatever it is. But Tesla is extremely oversold right now. Yes, I know it's expensive. Some people say it's too expensive, but it's oversold. It's starting to get oversold. And if we get the overall market bounce, Tesla's going higher. A lot of stuff in the pipeline there. All right. So yeah, that's the economic outlook right now. China's set to cut rates. Maybe they don't on Sunday, but I'm saying, hey, keep that in mind that China's near cutting rates again. Their economy is not as strong as we thought. They are near cutting rates going forward, right? It is Friday, so we have a whole weekend the market has the whole weekend to price this in, right? And next, home sales. Where are home sales at, right? Rebounding. Well, nothing really, home sales don't matter right now. We know the housing market is starting to bottom here. The most important factor we got is the global PMI. Is it recovering? That's manufacturing. This is what leads the economy is global PMI. And we get services, composite. Just go to composite. This is the global composite PMI. It looks like it's kind of trickling around here. If this thing weakens, it gives the Fed reason to pause. If it strengthens, it doesn't really give the Fed reason to pause. It depends on bond yields, right? Depends if bond yields go up. Durable good orders. This is important to the economy. Are we going to get more durable good orders where the manufacturing sector is starting to bid higher? Okay, so there's a lot of stuff to be answered, right? But again, the biggest factors are going to be have bond yields peaked, right? Are they at the top? Has the dollar peaked? It just had a big run. This is a big run from the dollar, right? We thought it broke down, up 4%. Okay, let's see. Last time it went up about 4.5%. Maybe it goes a little higher, but I think the dollar's pretty much peaked. It's in the downtrend. Okay, go to the weekly chart. See, is it bullish on the weekly chart? It has a 50-day moving average to move into. So yeah, this is the dollar. And yeah, that's what we're looking at here. Who's going to save the bond market? Also, if the bond market keeps crashing, will the Fed step in? Will the Fed step in? What do you think will happen on BRICS meeting next week? I think BRICS is a little overplayed, to be honest with you. I think people overplay. Nothing's going to change. Here's just one important factor. This is a macro factor when it comes to BRICS. 80% of global debt is denominated in dollars. So you can't just switch off the dollar. I know people get pissed off. What are you talking about? The dollar is evil. Well, it's still the best currency when it comes to safety, right? So BRICS is going to do what they have to do. I think it turns into a global, they have to use blockchain at some point to really get a trusted currency. They're going to have to do some type of blockchain. I think BRICS transitioning off of the dollar is a ways out. I don't think it's really going to be a factor this year at all. People say this they've been saying this since the 90s. I don't think it's going to be a huge factor. I think crypto technology is a bigger factor to leaving the dollar hegemony than BRICS. Okay, then BRICS. Maybe later in the future when India and China become the strongest economies, but China's weak right now. They have no demographics. India's set to be the strongest economy going forward because of their demographics, right? Because their population growth, because they have no debt. Yeah, so I don't think it's going to matter, honestly, bro. I think it's going to, the only thing that really is going to matter with BRICS is like, are they going to use Bitcoin to back their currency? Or are they going to use blockchain? That's probably the biggest factor. It has nothing to do with the dollar. Everybody's denominated in US dollars for debt. So they have to pay their debts in US dollars. What if BRICS didn't pay their debts, right? If they decided not to pay their debts, what makes you think other countries are going to trust them? So it's just not going to happen. Money is about trust, and the US dollar is still the easiest currency to trust. It's just the narrative is, well, the US uses the dollar as a weapon. They sure do. They sure do. Yeah. So, and also I think Bitcoin is bottoming out here. That was a big retracement back to 25K that you had the bounce on 25K. So keep looking at that. Anyways, check out the newsletter. Okay, I think we're done here. I don't see any more questions. Check out the newsletter. All right. It'll come out tomorrow or probably tomorrow. We'll have that out, or Sunday. I'm not sure, just to take a little review. Support me if you can. I love when people read it. Leave me a comment if you can. And that's all I have for you folks. Have a blessed evening. You know, get your workout, eat healthy, have fun, and stay blessed no matter what. You guys stay blessed. Appreciate you guys jumping on.